Yo, what's going on everybody? My name is Ryan and today we're going to do another episode of CPA Reacts to random crap on the internet. Sometimes it's dumb shit, sometimes it's normal people asking questions. Whatever it is, it's a good way to cover a broad range of topics in a short video. So let's just jump into it. All right, first one says, is there any strategy to reduce a crypto tax of $300,000 from 2020 tax year if crypto is now down? So this person is asking if there's a way to offset 2021 gains with 2022 losses. If obviously if you're watching this on like July of 2022, you'll know that the stock market and cryptocurrencies are currently in the red compared to the beginning of the year. And the simple answer is no. If you already sold your cryptocurrencies, at the end of 2021 and you realized a ton of gains, that those gains stay in 2021. You can't go into 2022 and offset those gains with those losses. And that's simply because, the gains and losses happen on different tax years. Now, if you actually had, if you invested in cryptocurrency a long time ago and 2021 was a big year, the values increased, but you actually didn't sell the cryptos, you just held on to them through the year, and the year ended and you still held on to them, then you don't actually realize those gains. The gains don't get realized until you sell the coins or until you, swap the coins, trade the coins, whatever it is. That's when you realize the gains. And, I have a video on cryptocurrency on what events would actually cause a gain to be realized, and you should check that video out if you're confused. But basically, if you have cryptocurrency and the value increases, just like a stock, the simple fact of it increasing doesn't mean that you have to pay taxes on the gains. It's when you sell the stock or the cryptocurrency that you will realize the gains, all right? And cryptocurrencies are a little different than stocks in that you can swap them. You swap Bitcoin for Ethereum, let's say. That swap event is considered as a sell and then a purchase. So when you do the swap, that's technically a taxable event. So short answer here, if you realize gains in 2021, you cannot offset it with losses in 2022 for the 2021 year. Now, if you do realize more losses in 2022, then you can use those losses to offset other income in 2022. You do have to realize that there are capital loss limitations against other sources of income. Hello, I'm a fairly new small business owner and need some advice if anyone can help. I'm looking to lease a Range Rover for 36 months, mainly for tax purposes. I went yesterday and picked out a Velar model. Okay, I know nothing about Range Rovers, but anyways, Velar model, but under the 6,000 weight for 179 tax code. I also started reading about this bonus depreciation, and I'm having a hard time understanding if it's beneficial to keep this truck, or should I go with a heavier model that would qualify over 6,000 pounds? Any input would be greatly appreciated. Okay, so what they were talking about, there's an SUV, it's generally referred to as the SUV loophole for Section 179 deduction, and I'm not gonna get too much into it, but basically if you buy a car for your business, when you buy any fixed asset for your business, typically you have to depreciate the cost of that asset over time rather than take the full depreciation, the full cost of it in the year that you purchased it. But because of Section 179 and because of bonus depreciation, which gives small business owners a tax incentive to grow their business, you can actually take the full cost of the asset in the first year as a deduction as a bonus depreciation. There are limitations to that when it comes to vehicles, which is why this person is mentioning the 6,000 pound rule. In general, again, I'm not going to get into it, but in general, if your vehicle weighs over 6,000 pounds, you can take a larger bonus depreciation and a larger Section 179 deduction. If your vehicle weighs under 6,000 pounds, then your depreciation expense is limited. I'm going to address one part of this question. This person says they're planning on leasing a vehicle mainly for tax purposes. That's not a good strategy. To do anything if you're primarily doing it just for tax purposes. I would not suggest you go buy shit just to reduce your taxable income, especially if you don't need the said shit. So always consider other things when you're making financial decisions, like, do you need this vehicle? Would company or your business benefit from obtaining this vehicle? If yes, then that's another point in the direction of getting a vehicle for your company. If you're doing it just, oh, I want a nice car and it can be a tax deduction. I already have 3 cars, but I want another one and it could be a tax deduction. That's a dumb idea, because the tax deduction is not worth the actual money you're spending to purchase the asset. Like you're buying a car for $50,000, you get a $50,000 tax deduction. That might equate to maybe a $12,000 tax reduction, but you still spent $50,000. So if you're doing things just for the tax deduction, that is likely a stupid idea. The next thing, this person said they want to lease a vehicle. So leasing is different from purchasing the car. So this person says they want to lease a Range Rover or something, and they're talking about the depreciation, the bonus depreciation stuff. And the thing is, if you lease a car, you don't get the depreciation expense because you don't own the car. Okay? If you lease a car, you get to write off the lease payments if it's legitimately a business vehicle. If you own the car, then you can take the depreciation deduction. Okay? But in this case, they're wanting to lease it, so there's no depreciation there because they don't own the vehicle. And along with vehicles for businesses, a whole lot of things come into play on whether it is legitimately a business vehicle. Some people just want to get a BMW X5 and put it under the business so they can get a depreciation expense, and they might use it like 30-40% for business. That's not a legitimate business vehicle. Okay, I would not recommend people do that. A legitimate business vehicle is like a work van that an electrician needs to have all his tools and equipment, stuff like that. That is a no questions asked legitimate business vehicle. When you're buying BMWs, Mercedes, that kind of thing, and claiming it's a business vehicle, things get a little gray there, and there's gonna be some audit tests done if you were to get audited. So just be careful with that. Question: what is the best entity structure to avoid showing any rental activity on personal returns? I currently have a parent LLC with 2 subsidiary LLCs, but as far as tax reporting, which entity will report the income from the sub LLCs? If, say, the parent company will pick up all the income, it could be an SCorp. But then again, W2 and K1 shows on my 1040. How do high-level investors not show all these activities on their personal? All right, so this is I don't know if this is a great question. It's a question. This person just wanted to not have any of their rental properties or rental incomes appear on their personal tax returns. And you don't see this, but in the comments below, they said that they just wanted it for privacy reasons, which is strange reason because your tax returns are already private. But either way, let's just jump to the answer to the question. The only way to have rental property and not have it appear on your personal tax return is to have the rental properties, let's say, in an LLC or a C corporation. Okay, that's the only way. So your LLC can elect to be taxed as a C corporation, or you can form a C corporation and have the LLC or have the rental properties held under the C corporation. Now you can have each rental property probably held under their own individual LLCs, but the sole owner of each of the LLCs have to be a C corporation tax entity. So while this will completely remove the rental properties from your personal return, this does not mean it's a good idea or something that you should do. And the reason you shouldn't do that is because there are many tax disadvantages of having real property in a C corporation type of structure when it comes to estate planning. Now I know estate planning is way down the road, hopefully, for many of you. Let me rephrase that. Estate planning should happen now, but the effects of the estate planning hopefully is way down the road for you. But either way, the rental properties in C corporations do not get the stepped up basis when they're inherited by your heirs. While if they're in an LLC or if they're owned by you personally, when you pass away, your heirs inherit your property, you get a step up in basis, and that is a huge advantage for capital gains purposes. All right, so having property in a corporation at all, S corporation or C corporation, does not mean it's a good idea. Also, C corporations, you've heard of the double taxations. Well, the C corporation will have to pay taxes on the rental income that your rental properties generate. And then if you wanted to pull that money out of the C corporation, you're gonna have to pay taxes on that as well. So you're getting taxed twice there on the income and then on the dividends that you pull out. So not really something I recommend people putting, you know, real estate in C corporation type of entities. I would just leave them as they are, either owned personally or maybe put them in a regular LLC for tax purposes. Now, if you want some legal asset protection, you know, you got to talk to an attorney for that, because I'm not qualified to make those recommendations. All right, question. I started a Colorado LLC, sole proprietor, in March 2019. Now it's been longer than 3 years, but I need to change to SCorp immediately. I've been told I have to wait until January 1st, unless I change my business name, since it's been longer than 3 years. Anyone know how this works, or if I can start a new business SCorp and absorb my existing LLC sole prop? Yeah, so basically, if you have an LLC and you have not made the election to become an SCorp by March 15th, then you are technically late. You technically are late for that election. And that election is actually technically 2.5 months after either the start of the year or the start of the company. And that's whichever one comes last. So if you started the company today, July 5th, then you have 2.5 months from July 5th to make the S election if it's an LLC. However, if you started it 3 years ago, then you have until March 15th of this year, 2022, to make the election. If not, you have to wait until March 15th of 2023 to do it. Now, there are ways to get the election done as a late election. It is very possible, and you can actually do it until the end of the current year. So you can do it, you know, safely. I mean, technically you can do it up to like 3 years or something, you know, 3-4 years. But, you know, I usually feel most comfortable doing it by December 31st for the current year, you know, retroactively making the election for January 1st of the current year. So yes, there are ways to do it. I would look up Revenue Procedure 2013-30 that has some language in there for how to do the late S corporation election. And obviously, if you need help with that, then feel free to reach out to us, as we do this crap all the time, all day, every day. Late election or not, we get it done. So that's all I got for today. Thanks for joining me. Again, my name is Ryan. If you found this video helpful, please smash the like button. And if you're new here, please do consider subscribing to my channel. We'll be putting a lot of videos out to help educate America on the tax code. And yeah, that's all I got for now. Stay safe out there, and I'll see you next week.
I'm in the mood for a switch up. I hit the function, hit the rose till I hiccup. I hit the stage and leave with money that's a sticker. She picture perfect, so I told him I'm a flicker. Bill, I'm in the mood for a change up. I leave the city and return with my change up.